Welcome to Market Map Global. Today we're diving into the for-profit education sector. Now, this is an industry that's really fascinating because it's sitting right at the intersection of huge demand, new technology, and, well, some pretty intense regulatory heat. So, let's break it down.
All right, so let's zoom in on our case study for today, Grand Canyon Education, or LOPE if you're looking at the ticker. What you've got here is a really interesting puzzle. On one hand, it's a financially solid company, throwing off tons of cash. But on the other hand, it's staring down the barrel of some major regulatory uncertainty. And that brings us to the big question, right? Can this powerful business model actually weather that kind of storm?
Okay, before we go any further, we really need to get our heads around this term OPM, or Online Program Management Provider. So what do they actually do? Well, you can think of them as the engine room for a modern university. They're the ones handling all the behind-the-scenes stuff, the marketing, the tech support, the admin, all that heavy lifting. This frees up the university to focus on what they're actually there for, the academics, the teaching.
So that's what an OPM is. Now let's look at how a company like LOPE actually makes its money. We're going to map out the entire value chain here to really see how they create value for their university partners and, of course, how that translates into revenue for them. This is the core of their entire operation.
And as you can see, this isn't just one or two services. We're talking about a completely comprehensive end-to-end model. LOPE is basically managing the entire non-academic side of a student's journey, from the moment they show interest all the way through to graduation support. And it's this incredibly deep integration that's the secret sauce. It's what makes these partnerships so sticky. And you know, the numbers really tell the story here. Look at that consistent revenue growth. We're talking steady, single to low double-digit increases year in, year out. So let's be clear. This isn't some high-flying, risky growth stock. It's the exact opposite. It's predictable, it's stable, and that's precisely the kind of performance that big, long-term institutional investors love to see. Now let's dig into the financial health, because this is where things get really interesting. Their model is super efficient, very tech-driven, and what that means is you get these gross margins that are consistently above the industry average. And higher margins, well, that translates directly into very, very strong cash flow. That cash gives them a ton of flexibility. They can buy back their own stock, they can reinvest in the business, all without having to pile on a bunch of debt. And it's not just growth for growth's sake. They're being incredibly strategic about where they focus. See this move into healthcare? That's no accident. They're zeroing in on these super high-demand sectors, aligning themselves directly with what the workforce needs right now. So this push into nursing and other technical certificates? Yeah. That's a really sharp, strategic move to diversify their income streams. Okay, so when you have a successful, profitable model like this, you know competitors are going to come sniffing around. It's inevitable. So that raises the next big question. How does LOPE actually defend its turf? What is its competitive moat?
And this comparison here really hits the nail on the head. You look at a competitor like 2U, and they're primarily an online-only player. But look, they've got this deep institutional knowledge from actually running physical campuses. Having expertise in both worlds, the brick and mortar and the digital, that gives them a pretty unique operational edge. And as you can see, it's reflected in their history of stronger profitability.
But the real heart of their competitive moat, the thing that's hardest to copy, is their technology. We're talking about a proprietary, highly integrated management system that they've built and refined over many, many years. It streamlines absolutely everything. And because it's their own tech, honed over time, it creates this massive barrier to entry. You can't just go out and buy this off the shelf. And you can see that confidence reflected right here in who owns the company. When you see high institutional ownership like this, it tells you something. It means the quote-unquote smart money, the big, sophisticated investors, they're buying into the long-term story. And look closer. The fact that you have pension funds and growth funds accumulating shares, that's a huge vote of confidence in where this company is headed. All right, but it's not all sunshine and rainbows. We've talked about the strengths, but now we have to look at the other side of the coin. The company is sailing into three pretty significant headwinds, and any one of them could seriously impact its future. It's absolutely crucial we understand these risks. Risk number one, and this is the big one, is regulation. The U.S. Department of Education has a whole host of rules about how these companies can operate, and they're looking specifically at two things: how recruiters get paid and these big revenue-sharing deals with universities. Let's be blunt. An unfavorable ruling here isn't just a problem. It's probably the single biggest existential threat to their entire business model.
Next up, we have partner dependency, or what you might call concentration risk. You know that old saying about putting all your eggs in one basket? While they're a massive partnership with Grand Canyon University is their biggest strength, but it's also a potential weakness. They are highly dependent on that one contract. If anything were to change with that agreement, the financial impact would be immediate and significant.
And the final headwind is something everyone's dealing with right now: inflationary pressure, specifically rising costs. They have to pay for skilled faculty and top-tier tech staff, and those wages are going up. If those costs start to climb faster than their revenue does, well, you can see how that would start to eat into those really healthy profit margins we were just looking at.
So, there you have it. A really strong core business on one side and some pretty serious external risks on the other. Given that landscape, what should an observer be watching? Let's put together a quick framework, a checklist, if you will, to track where this company is headed.
This table basically boils it all down to 3 key indicators. First, and most importantly, you have to watch the regulatory rulings coming out of the Department of Education or the courts. That's non-negotiable. Second, are those healthcare and nursing programs continuing to grow at a double-digit clip? That's your diversification story. And third, what's happening with the operating margin? That's your direct measure of how well they're managing those inflationary cost pressures.
I really think this quote from Market Analysis just nails it. It calls LOPE a strong cash flow generator with a regulatory turnaround catalyst. And that's the whole story in a nutshell, right? You've got this solid, mature cash-gushing business, but then you have this one big what if. If that regulatory piece turns in their favor, it could unlock a tremendous amount of value.
And so that really brings us back to the central question we started with. Is a powerful, efficient, profitable business model enough to see a company through a major regulatory storm? It's a classic battle between internal strength and external pressure. And how that plays out is something every market observer is going to be watching very, very closely. Thanks for joining this Explain.